What could they take from you? If you were sued today, what could they actually take from you? That's the conversation for this evening. Welcome to Free Law School. Does your LLC provide you with the level of limited liability protection that you signed up for? We're going to explore that. We're going to talk about, we're going to give you the answer of what they could actually take from you if you're sued today. And many of you guys are going to be surprised by what you discover, by what that answer is. Most LLCs were formed backwards, so it creates a lot of exposure. That's what we're talking about tonight. Put your questions, comments in the chat. We'll get to them. Talk about what could they actually take from you. Many business owners are surprised when the pressure event arrives, the lawsuit, partnership conflict, something of that sort, where the business structure becomes tested, only to find out that all of their assets are exposed, not merely personal business assets, but the personal assets as well. We're going to talk about what the purpose behind the LLC is, what protections limited liability is supposed to afford, and how to test your structure, how to evaluate your structure. That's what we're going to talk about tonight. So grab something to take some notes with, excuse me, and we're going to get into it. If you were sued today, what could they actually take from you? That's the question. And it's going to surprise many business owners, as it always does. I'm going to tell you right now, for many business owners, they can take your personal assets as well as business assets. Welcome. Come on in. Business owners, operators, entrepreneurs, side hustlers. This conversation is for you guys. Let me know in the chat where you're joining from and what industry that you're running, that you're operating out of, whether it's logistics, trucking, salon and beauty, med spa, real estate. This conversation applies across all industries. If you're just joining, the question for this evening is, if you were sued today, what could they actually take from you? Now, let's talk about the purpose of limited liability and the purpose behind actually forming an LLC, because there's a lot of misconception. Hello, South Africa. Thank you for joining. There's a lot of misconceptions behind why we even form an entity. Many people think that we form the entity primarily to start a business, but that's not it. That's incidental at best, because you can start a business and begin to sell goods and services or offer goods and services without formally forming an entity. That's the LLC, the corporation. I think for South Africa, it's the PIT Limited. Let me know if I'm pronouncing that right, South Africa. Give me a check, a thumbs up. And that's because here's the deal with that. That's because the entity is just a wrapper. It's just what we operate from. And every country, pretty much, or most countries, have their own form of the limited company. Here we call it the LLC. In the UK, it's a limited company. But no matter what the name of it, the purpose is the same. The purpose is to separate the business owner personal assets from the business liability. That's the purpose. That's the sole purpose, no matter where you're located, state, country, whatever. That's the purpose behind it. But again, in the United States, you don't have to form an entity. You can begin operating without an entity. That's called a sole proprietorship. The problem with the sole proprietorship, though, is that once we begin providing goods and services, if harm or injury results from that activity, we are going to be personally liable. That means that there's no protection for your personal assets, your homes, your bank accounts, financial accounts, vehicles, whatever you own of value, retirement accounts. All of those things are going to be exposed to the extent that they need to satisfy the judgment amount. One judgment, one substantial judgment could totally wipe someone out. It could take your home away from you. That's why we form the entity, to create that separation between our personal lives and the business obligations or business liability. There's a shield, okay? There's a shield that's created. Now, one of the misconceptions held by many business owners is the thought that creating the entity provides protection, or that the entity is actually the business structure. It's not. The entity just provides the container from which you operate. Whether or not there is going to be that limited liability protection depends upon how you operate the business. And we're going to get into some of that. Most business owners form the business without giving any real consideration to whether or not their valuable business assets should be separated from the operational risk, the risk that occurs by operating the company, customers, clients, employees, all of those things. For you guys who are actually operating a business right now, if you gave any thought to whether or not your valuable business assets should be separated from the operational risk, put structure in the chat. If you're just joining, the question for tonight is, if you were sued today, what could they actually take from you? That's the question. Now, here's how limited liability protection works. When we form the LLC, and we're using the LLC, it applies equally for the corporation. When we're talking about limited liability protection, there is no distinction, there is no difference between limited liability protection for the LLC and limited liability protection for the corporation. It's the same. It has the same meaning. It functions the same way. The business owner must separate themselves from the business once it's established. And that separation occurs through behavior, how we move, how we operate the business. Now, here's the purpose behind the limited liability protection and the benefit of limited liability protection. It has one purpose and one benefit, And that is, as stated, to separate those personal assets from the business liability. Now, that protection is conditional. It's conditioned upon maintaining that separation, understanding how to move the money, not mixing business and personal expenses, not using business funds to pay personal expenses. It's called co-mingling, or that's how it's referred. Knowing how to signing contracts on behalf of the business and not in the owner's personal name. Not acting as guarantor for obligations of the business. That's how the separation is maintained between the personal and business. Now, if the business owner is diligent about maintaining that separation and operating the business in that manner, when a claim arises against the business, and if that claim results in a judgment being rendered against the business by the courts, then those personal assets are going to be shielded. They're going to be safe. That's the purpose of the LLC. That's how it functions. The container at formation, protection is conditional, conditioned upon how the owner operates the business. And if the owner is diligent in the operation, the personal assets are going to be safe. Now, here's what limited liability doesn't protect. And many business owners are misguided or labor under the misconception that these assets are protected. And those are your business assets, the things that you use in the operations on a daily basis, your business equipment, even your cash reserves, your intellectual property, real estate, whatever you use in the business on a daily basis. If those assets are titled in the name of the business, that means that they exist at the operational level where all the risk occurs. Now, even though the personal assets were protected when the judgment was rendered against the business assets are totally exposed. And many business owners operate in that fashion on a daily basis without even knowing that their valuable business assets are exposed. They're reachable. There is no protection. LLC, the single entity, does not protect business assets. And when I speak of single entity, I'm speaking of business operators, owners who formed the LLC or corporation and began transacting business. That's it. Everything is handled in that single entity. That's why I asked the question earlier, and I'll ask it again. If you're just joining us, the question for this evening is, if you were sued today, what could they take from you? And for many business owners, the answer is everything. Because most businesses were built backwards. So what do you mean by built backwards? Here's what I mean. We form the LLC or the limited company, wherever you are. We get an EIN number, open a bank account, and begin chasing revenue because that feels productive. It feels like activity. When in fact, the proper order is to give consideration as to where those valuable business assets are going to be located, separating value from risk. That's the proper order, separating value from risk. But most business owners are really unaware of the need to separate the two because there's so much information out there that says just go and get an LLC, get an EIN, and start operating. But that provides absolutely no protection. So for many business owners, they're totally exposed both ways, personal assets and business assets, because many business owners do not respect the proper business protocol, operating protocol, as it relates to moving money, signatures, acting as a guarantor. So not only are the business assets exposed, but the personal assets are exposed as well. And so here's the other part about that. If there is no separation between the business owner and the business, then even if the business owner is sued in his or her personal life, the business assets can be seized. They're exposed because everything is under one umbrella. Imagine placing everything you've built in one pile, but also not only everything you've built, everything you owe, placing it all in one pile. So when the pressure event arrives, litigation, partnership conflict, employee dispute, breach of contract, and the judgment is rendered, the party that's owed, they can just come in and take whatever they want to take because everything is in one pile. And don't worry about calling the sheriff or anything like that because the sheriff is the one that let him in. Come on in, satisfy your judgment. There's a lot of misconceptions about business structure. And I blame part of it is the bad information on online. There's a lot of bad information on social media. Folks are selling business structure within the context of all kinds of arenas. Everything from business structure to get a grant, business structure if you want credit funding and a stack of cards. None of those things are truly business structure. Business structure is about asset protection, personal assets, business assets, shielding those assets properly, creating layers between the assets and the risk, as well as the ownership. You've heard it online. People talk about it all the time on social media. Own nothing, control everything. Well, within the context of business structure and the legal side of it, that is a separation between the ownership exists at one level, that's the trust level. The control and the assets should exist at another level, that's the holding company level. And the risk is isolated at the operational level by itself. And that's how we protect assets. The other pillar of business structure is tax efficiency because the entities that we form matters. It impacts how much taxes you're going to pay. As a business owner, surely we're concerned about that. And the third pillar, one that people rarely think about, that is continuity. What happens if the business owner has to step away from the business for a while? What happens if the business owner dies? Are the assets frozen? Business goes through probate? Those are all of the considerations of business structure. And that's why we're having these conversations to make you, the business owner, aware that many of your operations were not built properly. They weren't built properly. And there is exposure. And so what do you need to do? It's not paperwork, because paperwork does not in and of itself provide protection. You need to evaluate your structure, how you're operating, looking at your ownership, control, assets, risk, and continuity. And I've created a structural exposure check. The link is in the description. It's complimentary. You go through, answer the questions about how you're actually operating your business, not how you think you should be operating or what you think the answer should be, how you're actually operating. And it's going to provide you with a glimpse into or as to where your business may be deficient, where your structure is leaking. What about documentations? That's one of the biggest areas. So I know, again, if you're just joining, we're talking about if you were sued today, what could they actually take from you? And I know I've said that the structure, the entity forming the LLC provides no protection and that it's only a container. And we talk about limited liability being conditional, and it's conditioned upon how the business owner engages in those transactions going forward once the business is built. And here's how that works. Each time a transaction is entered into, it sends out a signal. And that signal is going to be used to classify the business at some point in the future. Not when it's happening, because business structure is only tested during pressure events, litigation, bank loan applications, insurance underwriting, real estate underwriting, investor doing due diligence, audits. That's when your business structure is going to be tested. It's never tested during calm periods unless you're doing an internal evaluation. And most business owners don't, because they labor under the misconception that the structure is fine. If they're making money, if revenue is flowing, everything is good with the business, then there's no need to even consider the fact that the structure may be problematic. It's only when those events arrive that the business structure gets tested. And for most business owners, it's too late, because you can't move things around at that time. The exposure's already there. It is absolutely necessary that if you're getting ready to launch a business, that you put your structure in the beginning. I've heard it many, many times, people saying, well, why would I be concerned about structure? Why would I incur the expense of paying a lawyer or someone else to talk about business structure when I don't have any problems right now? The business is not even making money right now. The best time to put in your business structure is before the money revenues arrive, and certainly before any risk arrives. That's the best time to do it. Once the risk arrives or any of those events, particularly legal events, you're going to be precluded from moving assets around. If you do, the courts are going to unwind the transactions, bring it back, saying that those transactions were fraudulent or done for the purpose of hiding assets from the claimants or judgment creditors. Most business owners skip the legal stuff, again, because it feels like a distraction. So let's look at it. What about some of those signals that are being sent out? They're all being documented in the paperwork, contracts being signed, formation documents. Is your name on your LLC? If we went to the Secretary of State's office right now and looked it up, is your name there? More than likely it is. If you're operating with a single entity, it's there as the sole member, manager, the responsible party on the EIN number. There's the name again, personally, on the bank account. Open the bank account, even though you brought the EIN number in, you signed the bank authorization in your personal name, in your personal capacity. Those documents tell the story. And when it's happening, we don't pay a whole lot of attention to it because it just feels like we're doing what we need to do in the business. But each one of those documents, each one of those transactions is sending out a signal. And when the crisis event occurs, the signal is going to be read, picked up, read, and used to classify as to whether or not the business is separate or whether it's personal. And most businesses, unbeknownst to the business owner, sends out those signals to a variety of institutions on a daily basis. Everything from banks, courts, insurance companies, investors, those signals are being sent out. And when you step into the bank and fill out the loan application, the signals are going to be read. When you provide that information to the bank. And if it says personal, then in many instances, the bank is going to ask for a guarantor. If the business is not independent, the interest rate may be a little higher. The repayment window may be smaller. Or the application may be denied, credit denied. And the insurance underwriters and real estate underwriters and investors, they all go through that same process. They have their own rules and their own things that they consider. But all of those institutions share one thing in common, and that is they're trying to make a determination as to whether or not the business operates independently of the owner or whether the business is dependent on the owner. Let's look at some more signals. What about your operating agreements? Many businesses have default state operating agreements. If you didn't create your own and you formed your entity through one of the commercial outfits, then you were provided with an operating agreement that pretty much reflects your state's default rules. Many things are left out that are important to a business owner, like voting rules, capital contribution records. Those don't come with just your default from LegalZoom, default operating agreement from LegalZoom or Rocket Lawyer or wherever you went. Restrictions on personal use of company assets. Those are the type of things. Meeting minutes, consents, written approvals. Those are the internal documents, the internal rules for your entity, whether you're operating an LLC, that's your operating agreements. If it's a corporation, those are your bylaws. What do they say? And so many business owners get it confused when the crisis event arrives, whether that's court, banks, wherever, and the first thing they default to is, oh, I have my paperwork. No problem, no worries. Everything is fine. I have my paperwork. But the paperwork can become irrelevant. And for many business owners, it does become irrelevant because the paperwork reflects that we get in the beginning, whether we created it ourselves or whether it's from some default scenario. Many times, the paperwork reflects how the business intends to run. All of these things are laid out in the beginning. Signing authority, how the money is going to move, all of those things are laid out in the beginning in these agreements. But over time, as the business begins to operate, the business activity drifts away from what's in the documents. Most business owners don't intend to act as the fallback for the business. If a business problem arises, the business owner has to step up and resolve it personally. If there are cash flow issues, the business owner has to step up and inject personal cash into the business. Rarely does a business begin with the owner thinking that that's the way that it's going to operate, but sometimes things happen. Those are called situationals, right? They happen. If it happens once or twice and it's documented and explained, no big deal. But if it becomes repetitive, if that becomes the normal behavior, then what's in the documents become irrelevant when the institution is evaluating those signals to make the classification. They're going to disregard the paperwork and they're going to go with the behavior. The behavior, that repetitive behavior, becomes the structural identity of the business. That's why it is important that the business owner understands how to move. That is so important. But nobody takes the time to talk about that. Nobody takes the time to tell you how to do that, how to stay safe. What are those documents? What are the institutions looking at? Banking documents. Again, we talked about signing the account opening documents in your personal capacity. Seems innocent. When it's happening, signature cards, bank account resolutions, benefit ownership forms. We go in and we sign and we don't think about it. But the separation problems show up in the banking and from in the banking when the business revenue gets transferred into the personal account. Owner transfers, unexplained, no documented, nothing is documented. Major decisions being made, but not documented anywhere. What about the payroll, draw, and distribution system? Is there really a system? Those are all the kind of things that you need to be aware of. So just forming the business provides no protection. And that's what we're talking about when we're talking about how does your assets become exposed during the course of the operation. And this is how it happens through these transactions. Every little single transaction. Again, one here, one there, no big deal. But when you begin looking at all of these documents from a cumulative standpoint, putting everything together, then the exposure becomes evident. Either the independence and the protection is going to be evident, or the exposure is going to be evident. There's no middle ground. And that's why we have these conversations. I represented so many business owners over my 30 plus years as an attorney. And it always takes the business owner by surprise. And it takes them by surprise in the very last stage, the stage in which they can really do nothing about it. It's terminal at that point. Remember what I said. Business structure is only tested during the pressure events. And one of the biggest, I can't even describe it at this moment. But one of the biggest problems is that the most successful business, cash flow, revenue, scaling, employees, everything good. Those businesses can be exposed as well. And in many instances, those businesses are exposed. Success can hide exposure. You're not even thinking about exposure because the business is successful. It's doing what it's supposed to do. So again, we have these conversations and for the purpose of helping the business owner close those gaps. Now, these conversations are not for everyone. They're not for everyone, but there are business owners out there who want to understand how to operate properly, how to separate control, how to separate or ownership from control, and from control and assets from operations. We're talking about putting together the trust, the holding company, and the operating company, creating all those layers and giving you the ability and the understanding to operate those entities and the relationships between those entities. Because again, it's not simply about the paperwork. You have to understand how these entities interact with each other. That is so important when it comes down to supporting the structure. Because when you find yourself in that event before the institution and in the litigation event, the other side is going to be attempting to poke a hole in your structure. That's what we call piercing the corporate veil, arguing to the court that your structure is nothing more than a sham. Those are just documents. The entities are not interacting. The contractual relationships between those entities is not proper. They're not real. And those are the things that we walk through. We help you put the structure together and understand how to operate and maintain that structure. But before any of that, again, we created a structural exposure check. This is an assessment that you can use to see where your business activity is drifting away from your documents or from the proper business protocol. But you want to answer the questions in the assessment based upon how you're actually operating your business. Not how you think you should be operating, how you're actually operating, because that's how it's going to tell you where the problems are in your structure. Again, if you're just joining, for most business owners, everything can be taken away. Everything. Your business assets are totally exposed. If all you have is a single entity, if you're operating out of a single entity, then all of your business assets are exposed because the LLC or the corporation, whichever one you have, the purpose is to separate your personal assets. It separates personal assets from business risk. Your business assets is subject to that business risk. If it's all in the same LLC, you're exposed. You're one lawsuit away from either writing the check to satisfy the judgment or sacrificing those valuable business assets. And I know it. Most business owners don't even know that they're exposed to that extent. So I'm offering you the structural exposure check. It's a diagnostic. The link is in the description. Take a moment, take the diagnostic. It's going to tell you where your structure, where your operations has drifted away from your documents. And if this creates that level of awareness for you and you're intent on fixing your structure and eliminating the exposure before any event arrives, book a clarity call. The description is there. The link is there in the description as well. Book a call. We'll get together. It's not a sales call. It's not a consult. We're going to map your structure, where you are right now, where your structure is leaking, what it takes to actually fix it and move on. That's the purpose of the clarity call. So I appreciate you guys joining the live this evening. I hope you have a great rest of your weekend, and we'll talk again.